Your car insurance bill just went up again, and you haven't even filed a claim. The average full coverage premium in the US jumped 46% between 2022 and 2024, according to Insurify's annual driver report. That number isn't a typo, and it isn't limited to one unlucky state. Nevada drivers saw rates climb over 28% in a single year. Minnesota and Washington weren't far behind, with nearly 20% jumps of their own. This pattern shows up whether you drive a 10-year-old sedan or a brand new SUV. Clean record drivers with a decade of safe driving are paying more too, which is the part that confuses people most. Europe is seeing something similar happen in parallel. Motor vehicle insurance costs across the Euro area have climbed steadily since 2022, based on Eurostat's harmonized price index. Hungary and Latvia show some of the sharpest increases on the continent, while countries like Ireland have seen milder movement. So, this isn't a US-only story about one greedy company or one careless regulator. Four real forces are pushing premiums higher on both sides of the Atlantic at the same time. By the end of this video, you'll understand exactly what each one is. Start with the biggest driver, because it explains nearly half the story alone. Cars themselves have become dramatically more expensive to repair. Modern vehicles carry cameras, radar sensors, and driver assist systems, technology known as ADAS. A basic fender bender that once cost a few $100s in bumper work now often requires sensor recalibration too. AAA research found ADAS-related repairs make up roughly 36 to 40% of total repair costs in common collision scenarios. Nearly 4 in 10 repair dollars on a minor rear-end collision go toward recalibrating a camera, not fixing the dent. Mitchell International tracked collision data and found 26% of claims in 2024 involved sensor recalibration. That figure was just 5% back in 2020, a 5-fold jump in only 4 years. Each calibration adds roughly $500 to a repair bill, sometimes more for multiple sensors. Many local body shops now need specialized diagnostic equipment they never needed a decade ago. And that investment gets baked into labor rates. Replacement parts costs overall climbed 45% since 2021, compared to just 15% for general inflation over the same period, per their AAA and CCC Intelligent Solutions data. Picture your car as a smartphone on wheels. Cracking an old flip phone screen meant replacing a simple piece of glass. Cracking a modern smartphone screen can mean recalibrating the camera and the face recognition sensor sitting underneath it. That same shift is happening in your bumper and your windshield right now, quietly, with every new model year. For your wallet, this means even a minor parking lot scrape can trigger a repair bill in the thousands. Insurers price your premium around that new, higher average claim cost, not the cheaper repairs of a decade ago. The second cause is less visible but just as powerful: rising injury costs combined with something the industry calls social inflation. This isn't about medical bills simply rising on their own. It's about lawsuit payouts growing far faster than the broader economy around them. Insurers point to nuclear verdicts, jury awards of $10 million or more, as a major driver here. Verdict awards in liability cases rose over 100% between 2020 and 2024, according to industry-tracked litigation data. The Insurance Information Institute estimates social inflation added over $20 billion in extra costs to commercial auto liability claims over the past decade alone. Here is the mechanism in plain terms. When a driver causes an accident, the at-fault driver's insurer may owe a jury-awarded settlement covering medical costs and lost wages. If juries award larger settlements for similar injuries than a decade ago, insurers raise everyone's premium to cover that growing risk pool. It's not just the person who got sued who pays. Think of a shared restaurant tab. If one table starts ordering dramatically pricier meals, the whole group's average bill rises, even for people who ordered the same modest dish. This cause is genuinely legal and structural, not corporate greed, and it varies sharply depending on where you live. Europe diverges from the US here in an important way worth understanding. Many European countries use no-fault or capped damages systems for bodily injury claims, which limits runaway litigation costs by design. The American tort system relies heavily on jury trials with open-ended damage awards, leaving far more room for this dynamic to accelerate. For your wallet, this means accident-free drivers end up subsidizing a legal environment they never personally caused or contributed to. The third cause has actually made headlines without most people connecting it to their insurance bill. Climate-related losses. Insured catastrophe losses worldwide topped $100 billion for 4 straight years, according to reinsurer Swiss Re's own annual reporting. In 2024 alone, Munich Re estimated global insured catastrophe losses reached $140 billion. Severe U.S. thunderstorms alone caused $57 billion in total losses that single year. Here's the surprising part. These losses get spread across every policyholder, not just people living near floodplains or hurricane paths. Insurance works by pooling risk across large groups of people, so when catastrophe losses spike anywhere in that pool, reinsurance costs rise too. Reinsurance is essentially the coverage insurance companies themselves buy to protect against unusually large payouts. That added cost gets passed down into every driver's premium, even someone in a landlocked state who has never once seen a hurricane. Picture a large company's shared health plan. If a handful of employees have very expensive medical years, everyone's premium can tick up the following year, regardless of who used it. Reinsurance rates jumped an estimated 20 to 30% in recent years as global disaster costs mounted year after year. Insurers built that expense directly into your local car insurance quote long before you ever saw the renewal notice. For your wallet, this means your premium partly reflects national and global weather patterns, not just your own driving record or your zip code. Now for the cause that surprises almost everyone, because it's brand new in 2026, tariffs on imported auto parts. In February 2026, the Supreme Court struck down a broad set of tariffs the president had imposed under emergency powers law, ruling 6-3 that this law never actually gave the president authority to set tariffs at all. That ruling ended a wide range of country-by-country import taxes almost overnight. But the 25% tariff, specifically on imported auto parts, survived completely untouched because it was issued under a separate, older law, one that lets the government impose tariffs on national security grounds without needing that emergency powers authority. In plain terms, the court knocked down one tool in the toolbox, but the auto parts tariff was built with a different tool entirely, so it kept standing. Cox Automotive estimates the auto industry absorbed roughly $30 billion in tariff-related costs in the first full year alone. Insurance data tracker parts. Trader found this tariff adds an estimated $80 to $100 directly onto a typical repairable claim. Insurify projects. Full coverage premiums could climb an additional 4 to 7% in 2026, specifically from tariff-driven parts inflation. That's layered on top of premiums that already jumped over 40% since 2021, compounding an already stretched budget. Here's why this cause feels counterintuitive at first glance. It has nothing to do with your driving, your location, or even your insurer's own pricing choices. A trade policy decision affecting steel, aluminum, and electronic components flows almost mechanically into your bumper repair bill within months. Think of your insurer as a middleman standing between you and the global auto parts supply chain. When the parts they ultimately pay for get more expensive because of a tariff, they pass that added cost forward quickly. The average vehicle on American roads is now nearly 13 years old, according to S&P Global Mobility's tracking data. older cars need more replacement parts over time, and most of those parts still come from overseas manufacturers. For your wallet, this means a decision made in trade negotiations is quietly showing up as a new line item on your renewal notice. So, is any of this temporary, or is it here to stay for good? The honest answer is mostly structural, with one partial exception worth flagging. Vehicle technology isn't going away, and social inflation trends tend to be sticky once they take hold in the legal system. Climate-related catastrophe costs are unlikely to reverse given current weather trends and rebuilding costs. The tariff piece is the most genuinely uncertain variable here, since trade policy can shift quickly with a new agreement or legal ruling. For consumers, the practical levers are limited but real and worth using. Raising your deductible, bundling policies, and comparing quotes annually can meaningfully offset some of this pressure. Choosing vehicles with simpler, less sensor-heavy repair profiles can also help, even if the underlying causes stay outside your control. Here's the takeaway for right now. Your premium is rising mainly because your car, the legal system, and the climate have all gotten more expensive at once. The global parts supply chain is adding fresh pressure too. Your insurer likely isn't charging you more just because it can get away with it. Here's a question worth sitting with tonight. If fixing a fender now requires recalibrating a camera, are we paying for safety technology nobody asked for? Or are we paying for a repair system that simply hasn't caught up yet? Subscribe if you found this breakdown useful, because World Stages exists to explain exactly why the everyday costs in your life work the way they do without the spin.